All right, you guys, just before we get started, I wanted to let you guys know we have a whole bunch of binders that were donated. So if you guys want 1 or 2 or 5, let me know. We have them up in the boxes there, so I can grab them for you guys at the break. You can take as many as you want. We just have a bunch, so feel free to use them for your work for the course or take them home. Yeah. All right.
Okay, good. Thank you. So how's everyone doing? Great. Nice to be here after a few weeks rest. Right. Good. Hopefully you continue to listen to the news, and for those of you that didn't do a couple of the assignments, hopefully you had a chance to do them. If you did do that, if you have those, can you just hand them in here? And then I'll chat about the assignment later on. Okay.
Do you want both the core values that are redefined?
Sure. Okay, why don't we start talking about what's been in the news? So over the last couple of weeks, anybody have anything they want to share about what's been going on? Go ahead.
I read that PayPal bought out Pi, so Pi settles credit card line.
Okay.
So they're buying them out to try to take out the Square. Yeah, Square. They would kind of compete with the Square.
Okay.
Online.
Excellent. Well, PayPal is one of the first kind of online payment systems that has been around for a long time, right? And again, what they try to do, we talked about this last night, is companies, what they'll do is, one of the reasons they'll buy another company is to either gain a competitive advantage because they didn't have that service, or if it's competing with them, they'll just buy it out to lessen the competition. Right? Yesterday, someone talked about, I think Patrice talked about Canadian Tire buying Helly Hansen, right? The brand name. So good. Anything else? What's been happening in the news? Go ahead.
CIBC profit line 25%.
Oh wow, 25%? And that's probably in this quarter, first quarter?
Yes, quarter and 3 months.
Wow. So who has a CIBC account? Now I know what they're doing with my money. Yeah. We're going to talk about how to put together a portfolio tonight, but what you want to do is try to keep at least 1 or 2 banks in your portfolio of investments, because banks always do well, right? Especially in Canada. You ever hear of a bank going bankrupt? No. Okay, and we talked about this in lesson 1 of, level 1, lesson 1 in banking, that Canada has such a good and regulated banking system that the chances of the banks going under are very, very, very low. So that's why they offer the insurance, the CDIC of $100,000 of deposits. But also because that's why the government offers that, but that's also why banks do so well, right? Okay, anything else? I was reading today, anybody heard of Tiffany's? Tiffany's, what's Tiffany's? Jewelry. See, a lot of the women know that. So Tiffany's announced their quarter results, and they were up, I believe, 17%, and their stock just rose like crazy. So what would make a high-end jewelry chain in this day and age actually do so well? Any ideas? What's been happening in the last few months?
Precious metals going up, silver, gold.
Okay, yeah, that's a little bit of it. But what's happening with the demand? Why is the demand for a lot of those things going up, especially in the States? What's been happening in the States over the last year? Trump. Yeah. So what's Trump? Good. Yeah. Good answer. So now, what's Trump been doing?
Doing business.
He's lowering taxes, corporate taxes. So think about this: lowering corporate taxes, and a lot of corporations last year in the States actually gave bonuses to their employees. You give money to employees, it injects money into the economy. And that's one of the reasons that the American sales for Tiffany's has done so well, but also their Asia Pacific portion of the business increased 25%. So when you think about, again, a high-end jewelry store, like why would you ever invest in that, right? Especially with more and more people, millennials especially, buying online. Here's a traditional business that's been around, I don't know if they've been around for more than 100 years. Tiffany's is making gains like crazy. And they also announced a stock buyback, right? So what happens when a company buys back their stock? They have a lot of liquid. Sorry?
Double the amount of the share.
Well, it increases the share price, right? Because they're taking shares off of the market. So it signals a confidence. That's what Apple did. Remember, we talked about Apple doing that a few weeks ago. So that's what Tiffany did. A big stock buyback. So people actually saw the value of their shares go up. They actually, because the market boosted the shares, they saw the value of their share goes up because of the stock buyback, and the amount of dividends actually increased from what they projected it to be. I think it was like a couple of bucks per share, right? So lots of stuff happening in the news that way. Okay, so continue to kind of listen to that. Let's talk about. I saw an interesting quote. You can read that, all you Leonardo DiCaprio fans. So stay away from negative people. They have a problem for every solution. Okay? So if you really want to get to your goal, try to stay away from people that are going to take you away from that. Right? It goes back to what we learned in lesson 1 is who do you listen to? If you're listening to negative people, you're not going to make heads forward in terms of your goals. So let's talk a little bit about the homework assignment. So I've marked the homework assignments. So just some comments on that. This is the one on Smith, right? The net worth statement. Okay, so overall the balance sheet was done pretty good. Okay, so a lot of people just had the numbers. Sometimes you may have missed something, and it's not a big deal, especially when you're talking about the assets that Mary and was it Bobby had, right? They had quite a bit of assets, so some people put a few things here and there. It's not going to make a big difference, but what some people did, which was really interesting, was that whenever you had assets, you had liabilities, and then the difference was equity. So let's just say you had $10,000 in cash. Let's say you had a home of $500,000. You had a vehicle of $50,000. Okay, so that's what, $560,000. Let's say you had a liability of $20,000. Let's say the mortgage on this home was $100,000. Then you have 120, 560, 460, 440,000 is the equity. Okay, and the balance is 560. Okay, so that's how a balance sheet looks like. But what some people did, really interesting enough, was only on the vehicles in the home, they took the net difference So 500,000 minus 100,000 and put 400 here. Okay? Which doesn't change your equity at the end of the day. But what it does is it reduces your assets. Okay? The liabilities are going to be less too. So that's not a problem. You still may have got the right number on the equity, but when you came to calculate the debt equity ratio, guess what? You didn't have any debt on this side. Or you had just the $20,000 of debt. So instead of showing $120,000 of debt on here, you only showed 20,000, which made your debt equity ratio wrong. So you had the right idea that you have to take assets minus liabilities, but you don't do it on the balance sheet. Okay? Understand that? So it was actually interesting that quite a few people did that. The other thing was that when it comes to your current ratio, so, and in the notes, I think we called it the current ratio, and it's also called the quick ratio. It was on page 31 that we talked about this. And really, that is a measure of whether you can cover your debts, your current debts, in the next month. So it's really just your current assets over your current liabilities. Okay? In this case here, this person doesn't have enough money to cover, if this 20,000 was their current liabilities, doesn't have enough money, it's 0.5, to cover their current liabilities. And what some people did was they put all the assets in there and all the liabilities in that calculation, which is incorrect. It's only current assets, and current assets are things that you have access to right away, which in this case was only the bank accounts, right? I mean, if you had to sell your stocks, the CIBC Investor Edge account, you could, but you have to sell stocks. So that's not liquid. If you had to sell the gold, you can sell it. Definitely the property is not a current asset. It's difficult to sell the property in the next 30 days. So you're only looking at disposable and accessible cash, which is typically things that you can sell right away, which is stuff that you have in your bank account. And with current liabilities, we're only looking at the debts that are due in the next month. So your credit card bill is due in the next month, your utility bill. We're not looking at the whole line of credit of $60,000 or $80,000, which that was, okay? So that's another thing that some folks did. So the other thing that was interesting is that some people did the calculation on the balance sheet, and then they either didn't do any of the ratios, which the ratios is now when you start getting into the numbers, but more importantly, didn't do anything about the recommendations. So think about that. You've been hired by the Smiths to do this, and I can just see the conversation. They come and see you, you sit down, you say, thank you very much for giving me the information last week. I put together your net worth statement. You guys are in good position. You have $1 million of equity. Thank you. That is going to be $150. What do you think? What do you think the Smiths are going to say? No, they're going to say, okay, I paid $150 for that. So what does the number mean? I got $1 million of equity. I told you that I wanted to reduce my debt over the next few years. What are you telling me to do? So some people didn't do any recommendations at all. Some people did maybe one or two. But if you go back to the lesson where we talked about how to reduce debt and even going back to level 1 on budgeting and credit, you could have come up with a lot of ideas on how they can reduce debt over the next few years. So when you pick up the assignment solution, there's 2 pages of recommendations. So go through them and get an idea of what you're kind of looking for when you do an analysis of whether it's your own or whether you do an analysis on the company, right? Because tonight we're going to finish off on how to pick stocks, and we're going to look at how to do analysis on a company. And coming up with just how much the company is worth is not going to give you a good idea of whether you should invest in them or not. Does that make sense? Okay. The other thing was that on the homework, if you are having trouble with some of the assignments, because the stuff, as you can see, builds on each other, right? Who's helping out this? Okay, we should get his number on the. So you can either call me or there's someone else that can help you on an assignment during the week. Don't just feel like, oh, I'm just not going to do it and just hand it in, right? This is an opportunity for you to kind of learn and apply the stuff. So if you don't understand something, if it seems a bit difficult, just give me a call or give Oleg a call, and we'll help you get through whatever it is so that you can get the assignment in. Okay, fair enough. And the other interesting thing was that remember I told you that red ink is a sign of love. Well, there's a couple of people that thought that was okay. I'm going to put my assignment in red. So they did their assignment in red. So for those individuals, you'll be glad to know that I've used purple. Okay? So purple now is a sign of love, and you'll see that. So when we have the break, come by and pick up a copy of the solution. There's the actual balance sheet, and then there's the recommendations, and then there's your assignment there. Okay. Next thing. So let's start talking about, so we talked about stocks, how to pick stocks last time. So as we were talking about that, it was kind of interesting. How do I make that bigger? That here?
Let's do up to 100, and then you can also make it full screen.
Okay, so it's kind of interesting. Remember I was telling you that you have what? When you buy shares in a company, you're called a what? A shareholder. And you have common stock or common shares. And what was one of the things about common shareholders? What do they get to do? They get to vote, right? They're commoners. They get to vote. One person, one vote. Actually, one share, one vote. So here's an example of a company that I have shares in. And what they did is that they're having their annual meeting. We actually had it, or they're having it on June 21st. Okay, it's in New Jersey, so I'm not going to go to it. So what happens is that because I have shares in this company, they send me this proxy voting form, which allows me as a common shareholder of this company to vote on things that are happening that are important to the company. So I get that in the mail. And then, let's see. And typically in an annual meeting, one of the things that you vote on is directors. Remember we talked about directors last time? Right? You had directors. And what do directors do? Does anybody remember? Sorry? What do directors of a company do?
We decide on
No.
to make sure that company.
They're setting strategy. Yeah, it's at a high level. Right? Then you have management that is really executing the strategy or doing operations. Okay? And this is owned by the shareholders. So I have a right to vote on the directors of the company. So here are the election of directors. Those are the names of the people. Well, I don't know any of them, obviously, but I can do some research if I'm really concerned about this company and the shares that I have in here. Do research on each one of these individuals. Find out what kind of individuals they are before I put my vote on here and send it in as my vote. So if I had 1,000 shares in this company, I'd have 1,000 votes, right? And there's another resolution there. So it's kind of, if I was at that meeting, I'd be voting on those things. So I'm able to do that by proxy. So you have a say as a common shareholder. So what's interesting is that now there's companies, they provide a service to people like me, for example, that may not know anything about these guys or about the resolutions. For a fee, 20 to 50 bucks, they'll advise me on who to vote and whether I should vote yes or no on certain resolutions. So it's actually almost like hiring someone to do that for you. Because especially if you own quite a few stocks, you're not going to do the research. But who you put or who goes into those positions is very important because it sets the direction of the company. And in fact, I think it was on Facebook, there's a resolution to remove Mark Zuckerberg as the head, right?
So we can,
Well, because of all the problems that's been going on with Facebook around privacy,
yes.
there's actually a resolution from certain shareholders, a big bunch of shareholders or major shareholders, that they want him out. So that might be one of the resolutions that you would have to vote on, right? So common shareholders have a big say on who's in here and who's in here, especially if it's affecting the share price, right? So you think of Warren Buffett, who we know owns now millions of shares of Facebook. He's concerned about what's happening with all the issues with Facebook. So he may be one individual that may vote against or for a certain thing. Okay? So any questions on that? That's how sort of proxy voting works. Okay, so let's continue with on how to pick stocks. Okay, so I think we left off right here. Okay, so you remember last week, a couple weeks ago, we took you through how a company becomes public. Most companies start off as private companies, slowly get bigger and bigger, and then at some point in time, if they need money to expand their operation, they go public, which means that now anybody can buy the shares. So we're talking now about buying or investing in public companies. So not all companies pay dividends. Remember, we talked about this a couple of weeks ago, that there's people that actually buy shares only in companies that pay dividends, because dividends are almost like rental income. And companies, you don't know how much a dividend is going to be until the company declares it. But you have an idea that if the company has a history of paying dividends, that they'll continue to pay dividends. That's why people invest in those type of companies. Because not only is your share price going up if it's doing well, but you're also making some money on the dividends every year or every quarter. And what's so good about getting dividends? Exactly, it's taxless. Remember, $1 of interest income is taxed at your rate, tax rate. But $1 of dividend income, I believe, depending on your tax bracket, is 17 to 20%. So it's a good way to tax shelter gains or income by investing in companies that pay you dividends. Okay? But we can classify companies into two types. One is called growth, and the other is called value. So growth represent companies that have demonstrated better than average gains in earnings and are expected to continue delivering high levels of profit growth. So companies like Facebook, like Amazon, like Apple, like Suncor, like General Electric, may potentially continue to achieve high earnings growth regardless of economic conditions. Emerging growth companies are those that have the potential to achieve high earnings growth but have not yet established a history of earnings growth. Okay, so they're either those companies that we talked about or those companies that have the potential to do that. Then you get into what's called value investing. So these are companies that have either fallen out of favor in the marketplace and considered bargain price compared to the book value, replacement value, or liquidation value. So a good example of this is what happened with BP a few years ago when they had what happened with BP, British Petroleum.
One of the refineries kind of
Yeah, in the Gulf, right? The oil spill in the Gulf, right? What happened to the shares? They went down, right? But you knew that BP's got a lot of money. They were going to clean up their act. They were going to pay whatever fines they needed to pay. So if you would have bought shares at BP when that thing was going on, where people were selling their shares like crazy because they thought they were going to go bankrupt, if you would have bought shares at that time, if you had the guts to do that, that's a value opportunity. Because since then, BP stock has gone through the roof. Same thing happened to Volkswagen. What happened to Volkswagen a couple of years ago? Sorry? Recall on why is that?
False claims on emissions.
That's right. They made some false claims on their fuel efficiency, right? So that's an ethical matter, which for some companies it spells doom. But Volkswagen is a big company. Their shares tanked. And if you would have bought Volkswagen shares at that time, okay, you would have been doing very well right now because they've rebounded very well. The only thing is that a lot of us don't have the guts to do that at that time, right? It's nice to look back and say, we should have done that. But remember what Warren Buffett says? When there's blood in the streets, that's when he starts doing his investing, right? So that's an example of a company that's fallen out of favor in the marketplace. Now, not all companies can get out of that, right? It all depends on the company. It depends on a lot of things. So you are taking a risk if you're buying their shares at that price. But if it's, again, the kind of established company that's been around for a while, you know they're going to be bouncing back. Okay, typically value stocks are priced much lower than the stocks of similar companies in the same industry. So if you think about it, when BP went through that issue, oil prices were actually pretty healthy. So all the other oil companies were doing well in the industry. So there was no reason for you to believe that BP was going to continue to stay that low. Right? Next time there's a train derailment in Canada, right? You're going to see shares of stocks for CN and CP go down. That might be a good opportunity for you to buy shares at that time. Because guess what? Those share prices are going to go up because right now, without a pipeline, how are we getting oil all over the place? By rail. In fact, they're over capacity. They don't have enough trains to carry all the agricultural stuff and all the oil. But we know that there's going to be a train derailment soon because it happens. It's a matter of just probability. So you can actually be a value investor by looking around the world and seeing when there's pretty bad things that happen, unfortunately. But that's when the stock goes down, but you know it's going to go up again. You can make yourself 20, 30, 40% gains very quickly just using that strategy. Okay, this lower price may reflect investor reaction to recent company problems, such as disappointing earnings, negative publicity, legal problems, all which may raise doubts about the company's long-term prospects. The value group may also include stocks of new companies that have yet to be recognized by investors. Right? So it's a different way of doing investing, if you will. Okay, growth companies, it's going to take a while for you to make money, but you're going to be guaranteed of making that. Value is where you can make easily 20 to 30% once that company gets out of that position. So, growth and value are two types of approaches or styles in investing in stocks. Value investors seek stocks that are priced near or below the value of the company's assets. Growth investors seek companies that are growing earnings rapidly. Value stocks may be more suited to the longer-term investor and may carry more risk of price fluctuation than growth stocks. Individual investors who purchase mutual funds or individual stocks can combine the two investment styles to help lower your risk. So this goes back to now what we talked about in lesson 1, which is what? What did we talk about in lesson 1? You did an assignment on core values, right? So I can tell by your core values, by reading them, whether you're going to be inclined to be more of a growth investor. So if you're very conservative and don't like to take risk, you're probably going to be going more on the growth side. If you're more of a medium to higher risk taker, chances are you're going to go on the value side. Okay? Either one is not right or wrong. Okay? Your values are your values. They're not right or wrong. They're just you. But you need to understand you, because that's going to help you determine what kind of investor you're going to be, especially when it comes to these type of stocks. And what you should do is really try to combine both. So if you're more of a medium to high risk taker, you should make sure that you have some growth stocks in your portfolio. And the opposite is true. Okay? So let's get back to the rights and advantages of common share ownership. So with common shareholders, there's a potential for capital appreciation. You have the right to receive any common share dividends by the company. Again, we talked about the favorable tax treatment. Won't get into that. And capital gains. The other good thing about investing in again, companies is that when you go to sell that stock, you only have to pay tax on 50% of that gain. So if you bought Apple stocks at 100 and you sold it at 300, that's a $200 capital gain, but you only pay tax on half of that, which is on $100 of tax. So it's as if you only made $100, but you actually made 200. So that's favorable. Okay. So we talked about common stock. Okay. And when you look at remember we said that a small business or proprietorship, a sole proprietorship, okay, you had equity, also called owner's equity. When you have a public company, it's called shareholders' equity. And the reason why is because the shareholders own this, not the individual company owner. Okay? And on the balance sheet, under equity, you'll have common stock, and you'll also have something called preferred stock. Okay, let's say that this is $1 million, and this is $1 million. That means that the company's net worth or shareholders' equity is $2 million. It's made up of both of these. So let's talk about what preferred shares are. So preferred shares are a class of ownership in a corporation that has a higher claim on the assets and earnings than common stock. Preferred stock generally has a dividend that must be paid out before dividends of common stockholders. And it's typically a financial instrument that has characteristics of both debt, which is dividends, and equity, which is also the potential for appreciation. So you can make money two ways on this also, okay? But there's less risk. Drawbacks are that preferred shareholders have no voting rights. So unlike common shareholders, they don't have a right to vote. But if the company ever goes bankrupt, preferred shareholders are first in line before common shareholders to get money out. So there's advantages and disadvantages. Okay? So when you buy shares in a company, you want to know whether it's common stock or preferred stock, because each one has advantages and disadvantages. Usually when you're buying shares in companies, it's common stock. Most companies have common stock. Not all companies have preferred stock. But you want to understand what you're buying into. And especially when you're buying into a private deal, which we'll talk about maybe starting today, you want to understand if is it common or is it preferred. Because if it's preferred, you have no voting right. But like I said, you will get paid out first if there's ever a problem with the company. So how do you buy shares? So what you can do is you can open up a low-cost brokerage account online, and all the major banks have it. CIBC, the Smiths had one with Investors Edge, but BMO, Scotia, all the banks have that. And you can move electronically into your account and start trading. And what they do is they charge anywhere from $5 to $10 a trade. So if you want to buy 100, let's say 100 shares of Apple, you go online, you look at the symbol for Apple. So Apple is going to be traded on the New York Stock Exchange. You put in the symbol, you can just put Apple in, and it's going to give you the symbol. And typically the symbol is 3 letters. I'm not sure if that's what it is, but you put in APP, it tells you what the price is today or right now, and you can buy shares right away, electronically. and it costs you, again, $5 to $10. Okay? Now, you don't get shares. You don't get the physical shares sent to you. Now, in some companies, when you're buying, especially if you're buying a private deal, they're going to send you the share certificates. And typically, they're going to have your name on it. But now, in this day and age, you don't get the share certificates sent to you. They're really held in a cloud or electronically for you to sell them if you want to sell them. Because think about it, if you had to wait until you got your shares and then you wanted to sell them, you'd have to send them back so that they have the shares to sell to the next guy. So in this case here, you're not getting the shares physically. Okay, stocks are traded on stock exchanges. In Canada, we have the TSX, which is a Toronto Stock Exchange, the Canadian Stock Exchange. In the US, it's the New York Stock Exchange and the NASDAQ, and almost every country has their own stock exchange. Okay, so let's talk about how do you choose? There's over 10,000 publicly traded companies. So you want financially strong companies with above average earnings growth. And if you want to put together your own, it's called a portfolio of shares, you want to have anywhere between 15 and 20 stocks. Yeah. But here's the caution. If you're going to pick stocks, you're going to need to do your homework. Most people, and I've done this, have bought stocks just because I heard it on the street, my buddy heard about it, right? Or I've listened to the news. The news is not always a good thing. You got to confirm some of that stuff. I mean, business news is good to listen to because we're doing that. But when it comes to actually investing money, before you do that, don't just go by a news report. Do your own homework. Okay? And this takes time to do well. And you have to look at both quantitative, which is the numbers, which is why we got you to do your own net worth statements to get you going, but also on the qualitative metrics, which are all those other things that aren't in the numbers. Okay? So let's look at a few things. So there's things that I call stock screens. You know, so how do you find out which ones are the right ones to purchase? Okay, use a stock screen. Okay, this is a set of criteria that can quickly compare stocks against each other to see if they meet your requirements. List your investment objectives. That's why we get you to do your core values at the beginning. Because what's your objectives? What's your goals? Do you want to have $100,000 in your portfolio in 5 years? Well, if that's the case, you're going to have to be more of a value investor because you don't have time to get there. If you have a longer term goal of getting that 100,000, you can afford to get into growth companies, right? It all goes back to that. But here are some of the things that you can use, and we'll go through these in a bit here. Earnings growth, price earnings ratio, market cap or size, relative strength, earnings, dividends, and then the industry. Okay, so selecting stocks. Everybody wants to know how to select stocks, and I always tell people you got to do a lot of work to do it. And you're going to find that out in the assignment that you're going to get this week, how much work it takes to actually try to understand what's going on in a company enough for you to make a decision. But you want to research the stock. You want to do some online research because there's tons of information now. If you think about even 10, 15 years ago, it was very difficult, I think, for investors to make good selections. So that's why a guy like Warren Buffett, man, I really tip my hat to him, because he was successful and has been successful when there wasn't the technology that you and I have today to get the information as quick as we do. Okay, SEC, which is the Securities Exchange Commissions, has what's called EDGAR. It's an electronic data gathering, analysis, and retrieval. You can spend hours looking up information on a company just in that database. Take a look at the company's annual report and its financial statements and conduct an analysis. So it's amazing how many people invest in companies, and I've done this too, where don't even look at their annual report. So if it's a publicly traded company, they have to produce what's called an annual report. And the annual report has all the financial statements that are audited, typically by an auditing firm, an accounting firm, and they have to be signed off that they're correct. And then it has a whole bunch of information about the company, the qualitative side. The CEO typically talks about where the company's going. They talk about strategy. So you need to read all of that if you're going to invest in a company, or I would. Because if you don't know that, how do you know if the company is going the right way or the way that you want that company to go? Okay? But you want to look at 3 statements: the income statement, the balance sheet, and the cash flow statement. So when it comes to the balance sheet, okay, debt. Remember what we just talked about, debt equity for the Smiths. Well, you want to do the same thing for a publicly traded company. Long-term debt divided by the equity is the measure that's used. The lower, not the number, the better. Remember? If it's below 1, that means that it has, let's say, $0.5 of debt to every dollar of equity. Okay? But just because it's high, just like in the cases of your personal, it doesn't mean that it's necessarily bad. It may be because they're funding capital growth. They had to go borrow more money to fund their expansion. But how are you going to know that if you don't read the annual report that talks about their plan for the next 5-10 years? You're not going to know that. All you're going to do is look and say, oh, the debt equity ratio is 2. I'm not going to invest in that company. Same thing on the personal side. You sit down with someone, they have a debt equity ratio of 2, and you say, oh boy, you're in trouble. But no, they're a young couple. They just bought a house or they bought a rental property. Their debt equity ratio is high. That's okay. You got to put the numbers in perspective. Cash. So here you want to look at relative to annual sales. Cash is always a good thing, but it could also mean that they're not using their resources wisely. So this is kind of interesting because there's people that when they get paid a dividend by a company, they get upset. Why is that?
They want it to be reinvested.
Exactly. They would rather, instead of having the money come back to them in the form of the dividend, they'd rather have that company keep the money, invest it, work out a strategy. So do you see how there's a difference of depending on the individual? Because there's people that all they do is invest in companies that pay dividends. That's what they want. And then there's other guys and gals that don't want that and are surprised when a company pays out dividends. So again, it goes back to what's your philosophy? What do you want to do? Okay? Return on equity. This is a measure of net income relative to the shareholder's equity. Obviously, the return on equity, the higher the better. Receivables and inventory. So this is when a company sells a product or a service and their customers have to pay them. High receivables is not a good thing. that means that they're not doing a good job of collecting the money. It shows up as an asset, but what are they doing to collect the money? Inventory, the same thing. Do they have too much inventory that's sitting on the books? That's a bad thing, because when you buy inventory and you can't sell it, what ends up happening? You've got all your money tied up in inventory. If you have low inventory, that could be a bad sign too, because that means that you don't have enough stock to meet the requirements of your customers. So you got to get into the numbers to look at that. And then the current ratio, which we talked about, is the ability for them to pay their short-term debt. So that's the balance sheet. So exactly what we just talked about with the Smiths. You got to know what the numbers mean. It's just that with publicly traded companies, instead of dealing with tens of thousands of dollars, you're typically talking millions and sometimes billions of dollars. But the same concept. That's why if you don't understand at a personal level, it's hard to understand at a company level, the basics. So that's the balance sheet. The other statement is what's called the income statement. So the income statement shows earnings growth. Okay, so does a company have a record of exceeding analysts' expectations? So what I mean by that is that whenever there's publicly traded companies, there's individual analysts that all they do is look at that specific industry, whether it's oil and gas, whether it's consumable products, and based on what they see the financial statements, they'll say the earnings for that company should be whatever. And then what happens is that companies like Tiffany's goes out and shows their actual results. If they exceed the analysts, that's good for the share price. If they don't meet the analysts' predictions, what happens to the share price? It could go down, right? So earnings growth, which is income minus expenses, is very important. Revenue growth is from year to year. And what you're doing is you're looking at margins. What a margin is the difference between the sales and the cost of those sales. So if I'm selling eyeglasses and I sold $1 million of eyeglasses for revenue and it cost me $700,000 of costs for those glasses, I have what's called a margin of $300,000. And then below here, then there's other expenses that I take away from the 300. But this is what's called my gross margin. And you want to see this margin, right? In this case, it's 30%, 300 divided by 1,000. But you want to see these margins go up. Because if the margin is going up, what does that tell you? Anybody know? Okay, but why do margins go up? Why would this number go up? Let's say from year to year. Exactly. Either you're selling your product for more, right? So your product is gaining more money, or the cost of those eyeglasses has gone down for whatever reason. Maybe you're buying more bulk. Maybe you got a different supplier, right? So those are good signs, but you have to see that year after year to see what the trend is. Okay? Stable or increasing research and development spending as a percentage of sales. This is especially in today's day and age. If you look at Apple, if you look at Amazon, how much money are they spending on research and development? So why is this important? Why do companies spend money on research and development? Okay, but Never do something just because it's a tax break. Exactly. It's more about strategy, right? So if you look at Syncrude, Syncrude has a research and development division in Edmonton, and they spend millions of dollars on that. And the reason why is because they want to develop processes, technologies that are going to lower their cost. Because if they can lower their cost, this number goes up. Especially for an oil and gas company where oil is not dictated really by the company, it's dictated on the world market. You have no control over that. So the only thing that you have control over is this number. And the only way you're going to get that number low is if you get better processes. So just an interesting story about Syncrude is that in the late 1990s, they developed a technology called hydrotransport. Anybody ever hear that? Nobody? Okay. What's hydrotransport? Anybody know? Exactly. So listen to that. So what was happening was that all the oil companies, Suncor, Syncrude, what they used to do is mine tar sand, send it to an extraction plant to extract the oil from the tar sand. But then what happens is that you start mining, and now you typically mine close to extraction plant. Then at some point in time, you finished mining here. And they used to send their tar sand on conveyor belts. So think about that. We're in Fort McMurray. Okay? In the winter, what happens in the winter? It gets really cold. And what happens in the summer? It still gets cold? No. It gets really hot. Tar sand gets sticky. Very difficult process of transporting the tar sand on conveyor belts. So at one point in time, Syncrude had about 30 kilometers, and Suncor probably the same, 30 kilometers of conveyor belts moving tar sand to the extraction plant. But then after you mine this, you get farther and farther from this plant. So the original plan had Syncrude finishing sometime in 2000 because they were going to be so far away from the extraction plant that it wasn't cost advantageous to do it. So Syncrude spent money on research and development, and they developed hydrotransport, where they put the tar sand in a pipeline, mix it with steam and chemicals, and now you're able to transport that tar sand to the extraction plant from miles away. Totally changed the whole oil sand industry. So that's when CNRL got into the game. That's when Shell got into the game. Before that, it was really lights out for the tar sand or oil sand industry. Okay, so you see the importance of research and development. And then Syncrude went on to sell that technology to other companies. And it's no different in Amazon, right? Like, why is Uber, spending hundreds of millions of dollars on autonomous vehicles? Same thing. They want an advantage. They already got the market, or they're getting a good size of the market on transporting people. Now they want to do it with nobody in the vehicle. They want to get rid of the driver cost. Okay? Why is Amazon spending money on research and development on drones and everything? They want to be able to deliver that product to you right away. Right? So very important to understand how much a company is spending on research and development, because if they're not spending anything, that may be a sign that in the next few years, that company may go under. Okay? But if you never look at that, if you never look at it, even look at that line as a percentage of sales, you're not going to know. Tax abnormalities, number of shares outstanding. Increases in the number of shares negatively impacts earnings per share. Remember I said that when a company continues to issue shares, what they're doing is diluting everybody's position. So they want to be very careful about doing that unless they have to do it. That's why it's very important that companies don't raise money just for the sake of raising money. Because when you raise money, all you're doing is selling more of the company to investors. So if I'm an investor, a current investor, my share of the company is going down if they continue to issue more shares. But if they're continuing to issue shares because it makes sense strategically, I want that. But you're not going to know that unless you read the annual report. Okay? So one last thing, and then we'll just take a break. Okay, and then there's the cash flow statement. So ideally, cash flow should be positive. And the opposite may mean, as we said, that they're having problems getting money out of their receivables. In any case, you need to understand why a company's cash flow is what it is. Okay, so let's take a break. 10 minutes, and then we'll come back. Come and pick up your assignment, and then we'll come back and finish off this side. No, I did.
Never gonna do this. I'll never again. guys want any binders?
Yeah.
How many? One each. And Exon order. Yes. Yeah, they say the Exon order. They call this the. Do you guys have any binders? Okay. All of our programs.
Well,
Oh, maybe, yeah, sorry.
Your problem.
Yeah.
You want to go with you? Yeah. Do you have any questions?
Just checking your name up on the. Oh, and for you.
Yeah. No, that's, you got it almost. Yeah. That's nice to see. I like very much too. Something personal. Because I think how that works. Because it makes more sense. Yeah. People don't. You can't get this. It's way too much. It's great.
Yeah.
yeah.
Most of their FT boxes already.
How's it going? How many people around there?
Today was so fun because I had to get something done. It has to be done by Friday, so I was like, oh, work on it all day.
What? Great.
And I started like at 8 in the morning, and then I started
Let me go see.
and he's like, oh, yeah, I want to show you this thing on your computer. He's like,
Yeah.
it's so blurry. I think it's my glasses. You're wearing your glasses. I'm like, that's when you know I've been trying really hard.
I just think you for art.
I was stuck in the office all this time now.
Yeah, every box has one.
Yeah, I always yeah. You're in the office.
There's red.
Me too.
Oh, yeah, that's one. No, it's not a big one. We're just bringing guys.
Smile. Maybe they don't spit. That's sweet. No,
And I've been thinking about your electric.
it was so much fun.
You want to take that? Great. It's a great one for you.
Oh, really?
I'll give you this one.
What do you think? What do you grab? What do you have? Email?
Yeah, I do email, but they need originals as well. Like it might be
Oh, yeah.
You guys already got it?
I didn't know that. Thank
You're welcome. Do you guys want to?
Sure, yeah.
There's different colors. Let's see. Red, black, gray, or blue.
There was a sale and a black.
That's red here. Do you want blue or black? Okay, perfect.
And actually, two of those tracks. I remember putting them in the back. So many binders. And my parents went, oh, Billy, all high school, you know, graduated university. We did they did the same. I think I had to speak.
Every year, they're getting about 8,000 dollars. That becomes income. Like, so,
We're using that. I would go to university.
that's called income. So they're gonna have
Yeah, it's all
interest
fun.
income.
I'm learning to figure out some digitize everything. So I think after this work, still my scans.
But this asking for the.
Even though they're getting, even though.
Oh, that's true. We extra credit.
That's called interest income. Now, remember, this is an income statement, so I didn't have.
I'll go back and look at the.
balance sheet. Now,
After you did you write in red?
No, I
Oh.
don't.
Were you? That's so cool.
Just before we get started again, Louis was just letting me know that he sent out an email with the link to the online videos of this class. So everything that Jay has been doing has been recorded. So you can access it through that link, and then you'll be able to go back and review if you need to for your homework.
Thank you.
yeah, so it's that way.
Yes, how are you?
Yeah, how's it going, buddy? All good?
Good. Both good. Yeah. Stay here or you go?
Now, this income feeds into the balance sheet. So that's where you see that. But it comes, it flows through the income statement.
That was
And then at the end of the 10 years, and then after you take these expenses, that net income is going to go into your cash. So we're dealing with two separate types of things. Usually a bond it's called, and you're thinking about that. It could be compensated quarterly. And then there's bonds that don't pay. Typically bonds pay something like that.
I thought investments. Just
And then at the end of the second last year, so you would have made 100.
Correct.
So the answer is close, right?
Yeah, there you go. Right now, my.
Grand that you're making, here. So
got them.
You could always say that
Got shipped for
some of these
Oh, yeah.
they
They
have
were,
a
gas
conversation.
prices.
Now, if I would have asked you to do income statement, you would need their
Vaccine, but still.
actually you would also the interest
Frozen. Yeah, yeah. Yeah. Okay, pretty good size.
yeah, because you could have put it in there, but because it's 1 year, I didn't say that.
People guy or more of like
Just because I said that it's an annual expense. And I didn't say, I could have said, this is what they're owing, this is what they're like.
Bill?
And if I would have done that, you would have put it in
I like that weird. Yeah.
What?
okay, because all $60,000. So like if you told now the payment on
Something.
yeah, current credit card. But let's say that I want to say that a big pay, let's say $1,000.
Different proceedings.
Then that $1,000.
Okay, but
I didn't say that. Yeah, but the credit card, because it's only 30 days, is current. This is long term. Because it's not
yeah.
so long term. So when you're calculating your ratio, your current ratio, you're doing current.
Oh, oh yeah, that was I excluded them. That's like
You can, but it's not. Well, same with the same with the timeshare. Current means that you can just have access to it.
yeah.
So I usually think of everything else takes effort to translate it. Now you can sell it.
Yeah.
But it can take a while.
Okay, I didn't know that. All right, yeah. Thanks a lot. Thank you. Thank you.
Okay, let's get started again. So any surprises on your assignments?
Expected.
Love the love notes. You love the love notes? That's great. Yeah, no, use that as a learning, right? In terms of go through the recommendations and think about, okay, what's the solution and why we would have recommended that for the Smiths, okay? Because again, you're doing it at your personal level. Now you got to take it up a notch and you're going to look at it at a company level. So the next thing I want to do is, since we're talking about financial statements. So I got this on here, Jamie, but it's not showing up. I've got it on the financial statement, but it's not.
Oh, I think you'll have to go back to the PowerPoint and exit.
Close it.
Yeah. And now you can.
Okay.
There.
Okay, so go to page 68.
I'm upside down, so it's hard to.
Okay, let's go down. Oh, sorry. If I want to go over one, how do I do that? There we go.
Do you want to zoom in?
Yeah, just a little bit. Okay, so on page 68, here's an example of a balance sheet. It's called a statement of financial position, but it's really a balance sheet. So look at the different classes. So we got, this is for Sun Life. So Sun Life is a big insurance company, and this is in millions of dollars. So when you look at this, 8642, that means it's $8.6 billion in their bank account. Okay, so a little bit more than the Smiths. Okay, but what you want to do is always look at what this is in. If it says millions, that means that this is in billions. And if it says thousands, it means that this is in millions. Okay? Understanding a bit of accounting now. You look at the date, and remember, it's always as of a certain date. So this is as of December 31st. I can't remember which year, but you'll notice that it has assets. So in assets, it has cash. We're not going to go through all of these because these are just different assets for an insurance company, but very similar to the Smiths in their bank accounts. Then they get into invested assets. So these are Sun Life's investments, which is no different than the Smiths CIBC Investor Edge account. It's got other insurances, intangible assets. Remember I talked a couple of weeks ago about goodwill? Remember, goodwill is something that's worth for the company that can be valued in accounting terms. Now, you don't do it for your own personal statement, but there's companies that value goodwill because Sun Life has a brand name, and that's worth something. And that's actually worth $5 billion on their balance sheet. Okay? So then you get total assets of $258 billion. And you'll notice that for 2016, and then on the other column, it compares it to last year's numbers. So you get an idea of what it was last time. Then you move into liabilities. Okay. So liabilities and equity, right? Sound familiar in terms of what we learned? Here's the balance sheet. Assets minus liabilities equals, in this case, shareholders' equity. So you have liabilities, and they have all different types of liabilities. You don't have to worry about each one of them, right? It gives total liabilities, which is $235 billion. And then the difference between the assets and the liabilities is your equity. So this company is worth $22 billion to the shareholders. You'll notice that the shareholders' equity, now this one is just a summary. If you go into their financial, into their annual report, these shares may be broken out into the different classes. There could be class A, B, C, depending on how many times they've issued shares. And it'll also tell you whether they're common stock or whether they're preferred stock. Okay, but this is the whole section. So this is really what the company is worth at that point in time, $22 billion. Okay? So let's go. Yeah, so how do I do that? Do I need to get out of this first?
Are you going to the next statement?
No, yeah, next statement.
Oh, I'll grab the mouse.
So next thing we're going to do is we're going to look at the income statement, right? So same thing that we talked about.
This one here?
Yeah. Well, that's a change in equity. The next one.
That one?
Can you go to the next one? There it is. Yeah. Make that bigger.
It's so hard to zoom in.
Yeah, so the income statement shows income minus expenses.
Sorry, it is not cooperating.
Not cooperating.
There we go. Okay, it's good.
Okay, so this is the income statement for Sun Life. So they had revenue, okay, of $28 billion, which is pretty good compared to last year's, right? So I would look at these numbers and say, what, you know, what's really gone up, right? Compared to last year. They're trying to understand that. But these are all their revenues. And then we go. After that, you look at all of the expenses that they have. Okay. So you have total benefits and expenses, Okay. So total net income is what you look at here, and it's either an income or a loss. So they've had $2.5 billion of income in 2016. Okay. You go down a bit. You'll notice that they have preferred shareholders dividends. So these guys pay a dividend to their preferred shareholders, but they don't to their common shareholders. Again, it's just the way they do it. So what it shows now is that was the net income. And now it also shows your earnings per share. So what this means, basic earnings per share means if you were to take the net income divided by the number of shares outstanding that they have, each share has an earnings of $4 a share. Okay? Anybody know what diluted earnings means? Obviously, it's a lesser number, but any idea of what? Just 2 cents less. But what do you know what diluted means? I'm sorry?
Reducing?
Yeah, it's reducing, but why is it a lower number? Dilution means that a lot of times companies pay their directors and their executives with what's called stock options. Okay? Stock options are a way to pay people that are directors and executive, and it's an incentive for them to do well. So the way it works is that they say, okay, Jay, we're going to pay you, we're going to give you 1 million shares or 1 million options at $2 a share. Okay? And what I'm planning or what I'm hoping happens is that the price of the Sun Life shares are higher than $2. Because if they're higher than $2, let's say they're $3, I have 1 million shares at $2, I've made $1 million profit. That's called an option. But I have to exercise that option. So what that diluted means is that if every person that has options exercises their right, it would reduce, obviously, the earnings, right? Because it's paying out that amount of money. So that's what diluted means. Any questions on that? Go ahead.
I'm doing that with the director, but the director actually has to, so they have the option to purchase, basically. So would they actually have to put up money to purchase those?
It depends.
Or, yeah, or would it just be
Sometimes that's called a phantom stock option plan. We're going to get into different crazy stuff here. So phantom means that you don't have to give them the 2 million to get the 3 million. But in most options, the guy has to come up with $2 million to get 3 million out. Okay? You actually have to buy it. Okay? So that's what that diluted means. And then you'll notice that it's dividends per common share. So sorry, they do also pay a dividend per common share, Sun Life, and it's right here. So for every share that you have in Sun Life, you would get $1.62. Okay, so those are the financial statements that you want to look at. The basic ones: income and the balance sheet. Now, we didn't do an income statement for the Smiths because that would have been another exercise, but you did the balance sheet. Okay, this is the same thing that we're looking at here. Any questions on those? And then you can look at those numbers, look at them from year to year. And what some companies have in their annual report is a look at those same numbers over 10 years. Because now you want to look at the trend, right? So one of the things we talked about was research and development. I want to know what's the trend been on R&D. I want to know what the gross margin's been on over the last 5-10 years. Is it going up? Is it going down? That type of thing, because that's important. Okay? Any questions on the financial statements? Pretty basic, right? Sorry, Nadia? Yeah, it shows there's a lot of information on company. You don't have to go to the annual report, but the annual report will give you a lot of information that you won't find in just the statements, right? That's why that Edgar database is important. Okay. So let's go back to page 62 and look at different things that you can look at. And consider the company's value based on quantitative measures, such as earnings, the financial statement, and also qualitative measures, which we'll talk about, such as their management, their reputation, etc. So the first thing you're going to look at that is commonly measured is what's called a price-earnings ratio. So this is a measure of how expensive the stock is. A P/E ratio is equal to the stock's market capitalization divided by its after-tax earnings over a 12-month period. I'll talk about that in a sec. The value is the same whether the calculation is done for the whole company or on a per share basis. The higher the PE ratio, the more the market is willing to pay for each dollar of annual earnings. Ideally, the PE ratio should be less than double the projected return, okay? And market capitalization, you'll hear a lot about this. You'll hear something that says market cap. Market cap is the current price of the share times the shares outstanding of the company. So when Apple has a good quarter and the share prices goes up, what happens to the market cap? It goes up. Okay, the market cap is really what the company is worth. When we looked at shareholders' equity, we looked at December 31st, 2016. At that point in time, I believe it was worth $2.6 billion. But over the next month, if the share price for Sun Life goes up, market cap goes up, and really the equity goes up. And the opposite is true. If the share price goes down, then the shareholders' equity goes down. But market cap gives you an idea of how much the company is worth today, at today's share price, whatever that is. Okay? The next one is price per sales. Okay, this is a stock's capitalization divided by its sale over the last 12 months. Okay? A low price to sales ratio, for example, below 1, is usually thought to be a better investment since the investor is paying less for each unit of sales. Okay, but you have to look at the whole picture. So again, that's just another ratio. Price earnings growth. This is equal to the stock's price earning ratio divided by its average earnings growth rate. Okay, in general, the lower the peg, the better the value because the investor would be paying less for each unit of growth. Okay, so these are just financial things that you look at. You look at the financial statements, income statement and balance sheet over the last few years, and then you have some ratios that you can calculate. So that's on that. That's quantitative. Now we're going to look at the qualitative side because there's two sides to the coin. So on the qualitative side, you want to look at management. Who are the people at the top? Because they're the ones that are making the strategic decisions. Okay? You know, where do they come from? What kind of education do they have? So if they're investing in a company that's a technology company and the person doesn't have any formal education, you know, you may be taking a risk. Right? If it's a research company and you got people that are PhDs, well, then that's a good sign, right? If there are tradespeople, nothing against tradespeople, but that's not a good sign for a research company, right? So you want to know who's at the top. You want to know the management philosophy because every CEO has a different style and a different kind of, that's why companies change CEOs. But you're not going to know that unless you read the annual report. You're not going to find what the person thinks about the company on Google unless the annual report's on Google. But you have to read the annual report and you have to look and see, okay, what's the message? What message does a CEO have for this company over the next 5 years? Okay, what the company does and how it makes money? Do you know and understand the business model? Right? So you don't have to know everything about how a company works, but if you don't understand the basics of their model, it may not be a company you want to invest in. Okay, Amazon's pretty easy, right? They're really a warehouse that sells goods to consumers. Pretty simple. Okay, Apple sells electronics. Pretty simple. If you get into a company that you don't understand what they're doing, you want to stay away from it, or you need to do some research to find out what they're doing. The next thing you want to do is look at the industry and the competition. So you don't just look at a company in isolation. You got to look at the industry itself. What's the market growth? Now, unfortunately, I did this view graph a couple of years ago when railway wasn't that popular. Now it's very popular because things have changed because there's no pipelines, right? But a few years ago, railway and even coal wasn't a good business to get into. Coal is starting to go down, but I also read that the remaining companies are making record profits right now because there's only 3 companies that are doing it in the world. Okay, so you can look at things from different perspectives, but you want to look at the potential in that industry. Market share. What market share does that company have in the industry? So if you look at Apple, it's pretty good, right? Their main competitor obviously is Samsung, and there's a few other smaller ones, but they got a pretty good market share. Barriers to entry. Anybody know what that is? What are barriers to entry? Sorry? Yeah, it's something like competition. It's how easy is it for another company to enter that industry. So a good example is the automobile industry, right? There's major automobile makers. Now, if you and I wanted to start an automobile company, it'd be a pretty tough feat, right? The barriers to entry are high, very expensive to get into. We have no market, no marketing channels, very difficult. On the other hand, if we wanted to open up a restaurant, how easy would that be? Pretty easy, right? You want to open up a burger restaurant? Very simple to do. You make good burgers, you compete against Wendy's, McDonald's, Fat Burger, all of them. It's easy to do. So you want to understand how easy is it for other companies to get into that industry before you invest. Then you want to look at the brand name. So this is very important. Okay? This reflects years of product development and marketing. So we talked about goodwill. We talked about companies that have good brand names like Coca-Cola, right? Tide, Pampers, right? Those are all companies that have good reputations. So that's important. Some investors stay clear of companies who are branded after an individual. Anybody heard of Martha Stewart? Right? She used to have a big company selling books and her TV show around cooking and entertaining. And then she got caught up in an issue with insider trading. Insider trading is illegal. That's when you get information about what a company is going to do that's going to affect their share price, and you act on that before it gets out to the market. That's called insider trading. It's illegal, and if you get caught, you go to jail. Martha Stewart went to jail, and her empire really crumbled. So if you had invested in her company, you wouldn't be doing very well right now. Subway. You guys heard of Jared? The guy that lost 8,000 pounds eating Subway for a month? Anyway, they put a whole campaign around him, and then he got charged with some child molestation stuff, whatever. They had to take them all out, okay? You want to be careful about getting in with companies that build it around one individual. And that's why you see that anytime there's some celebrity that's backing a product or a service, and there's some controversy about that individual, what do? They let that person go. Right. Okay? Because of the human factor in the market, quantitative measures are just as important or more important than quantitative ones. So my point being is that you can't just look at the financial stuff. Because stocks are based on people's perceptions and they go up and down, just like BP, what happened with BP. These qualitative measures are just as important or more important than the financial numbers at times. Okay? So, having said all of that and doing all that work to determine whether you're going to invest in a company, here's some of my rules for picking stocks. Invest in stocks that are easy to understand and have a simple business model. Right? Starbucks, Johnson & Johnson, we talked about McDonald's and Apple. Very easy. Invest in companies that are called best in breed, which means that they're the best in their industry. They're well established. Nike, Coca-Cola, Ralph Lauren. Those are the biggest names in those industries. If you invest in those, you're going to do well over the long term. Pick stocks that have a good performance history. So major banks, like we talked about earlier. How much did they make last quarter? Sorry? Exactly. You know they're going to make money. So in your stock portfolio, you should have at least 1 or 2 banks. 1 or 2 banks from Canada, 1 or 2 banks from the States. You're going to do well. Invest in mid to large cap companies overall. So what I'm getting at is try to stay away from small companies, because small companies are going to be a little bit more risky because they haven't proven themselves. And the chances of you losing all of your investment is very low. And we're going to talk about private deals next week, which are a little bit more riskier. Okay? Try to focus on companies that pay out dividends, if that's what you want. It provides an additional investment on top of the value of the stock going up. You're also going to make some money as a dividend pays out. Okay?
Question around the dividend. If it's in a safe, is a dividend so
That's right. Anything in a tax. So first of all, a tax-free savings account, it's only tax-free on the capital gain. Dividend income goes in as income. It's separate.
Okay, so the dividend doesn't go.
It doesn't go through that.
It's just the gains on it.
That's right. Only the capital gain goes through the TFSA and you pay no tax. Dividend income goes into your taxable income, but it's taxed at that lower rate. Okay? So, having said all of that, seems like a lot of work, doesn't it? A lot of work. So that's why picking stocks is very delicate. It's a skill. You don't learn overnight. You make a lot of mistakes. You can lose a lot of money. You can make a lot of money. But you have to have an idea of what you're doing. Not everybody has the time to do that or the skill to do that. So one option is mutual funds. Very quickly, what is it? A mutual fund is an investment program funded by shareholders that invest in diversified holdings and is professionally managed. So how does it work? You go to a fund manager and you give them, let's say, $10,000 to invest. They take your money and they invest. They pick the stocks. They pick the Apple, the Nike, whatever. They invest in those stocks, securities. Hopefully they generate returns and they go back to you as an investor. So there's advantages to that. One is that you don't have to worry about it, right? You're letting professionals or so-called professionals do it, okay? Risk management, it diversifies your risk. It's professionally managed. Reduction in transaction costs, liquidity, you can get well-regulated, transparency, and it's convenient. The disadvantage is there's no tailor-made portfolio. So you can't say, I only want to invest in oil stocks. Now, there are mutual funds that invest in that, but you can't just pick your own stocks. You got to give your $1,000 or $10,000, and they do that. And these guys, like I said, make a living doing that. It's a multi-billion-dollar industry, the mutual fund business, because most people, not only do they not want to do it, right? They just, a lot of people don't know what else to do. So they just get mutual funds at the bank. There's no control over cost. What I mean by that is mutual funds charge a fee. So these guys and gals, they take a fee for you for managing your money. And the interesting thing about these fees are they're pretty high. Can range from 2 to 3, 4%. And they make their money whether you make money on that investment or not. That's the catch. Okay?
And if you are closing, you need to pay.
Yeah, you still have to pay. So they have different fees, and you have to understand the fee structure. There's fees that are called front-end loading. That means that if I give you $10,000, they take the fee right off the top. Okay, let's say it's 5%. They take that money right off the top. So instead of having $10,000, you only have $9,500 to invest. Then there's back-end loads, which means that they take the money when you sell, and then there's fees in between the years that you buy and sell. Okay, so you have to understand what those mutual fee costs are when you get into a mutual fund. But most people just go to the bank because the bank sells mutual funds. And they don't want to do the work to select their own stocks. So this is your option. Okay? There's a second option. It's called exchange traded funds. And those of you that, anybody come to our last network meeting? A couple of people? We talked about this. Oleg talked about it. Excellent job on that. This is now a third option that's come out just in the last probably 10 years. But what these do is it's a marketable security that tracks an index, a commodity, bonds, or a basket of assets like an index fund. So let me explain what that means. Okay, so instead of going into a mutual fund where you just give the money to someone and they pick the stocks, this is you're giving money to someone and they actually track an index. Okay, so unlike mutual funds, it trades like a common stock on a stock exchange, and ETFs experience price changes throughout the day as they are bought and sold. Okay, so you get the advantage of a mutual fund, but it's tracking something different than what a mutual fund manager thinks is going to do well or not. Okay, advantages, tax benefits, simplicity. These fees, I believe, are, I think, 0.6% versus 2 to 3% on mutual funds. That's a huge difference. Investing flexibility and transferability of ETFs. So you should do some research if you really want to start investing. I always tell people you should always buy some stocks because it helps you understand the whole process. And it's actually fun, especially when you make money. Okay? Especially if you would have bought Apple a long time ago, right? It's fun to do that. So you should try doing that. But if you're not comfortable putting all of your investment dollars in that, then ETFs are good. If you're going to do mutual funds, I'm not here to, dampen them, but you want to understand all the fees. Because mutual funds are supposed to be professionally managed. But I was reading an article probably about 5 years ago in the Globe and Mail, and what they do is they had a contest, and they picked 10 of the best mutual fund managers in Canada and a monkey. Okay? And then the mutual fund managers were asked to select their portfolio of stocks for the year. And for the monkey, they gave him or her a dart, I don't know, it's male or female. And the monkey just threw a dart, and it had different companies, big companies. And at the end of the year, the monkey came in third place. And they didn't have to pay the monkey any money, no fees. My point being is that you may be paying a lot of money to mutual fund managers because they're supposed to professionally manage, but sometimes they're no better than you and I at picking stocks. Now you think they'd be better because they probably have more education in that area and experience and skill, but not necessarily. So if you're going to do mutual funds, especially through a bank, because that's what they're going to sell you through your RSP, through your TFSA, make sure you understand the fees. Okay. Any questions on that? Go ahead.
What are the tax benefits of ETFs?
The just the capital gains. Yeah, the capital gains are, it's very similar to mutual funds, but you have to make money. Whereas in the mutual fund, if you don't make money, you don't get any capital gains, okay? Anything else before we just talk about the assignment? Okay, so the assignment, if you can go to page 73. Okay, I'm going to ask you to evaluate a company. It's a publicly traded company, and you'll have on page 70 to 72 is the financial statements for 2015 and 14 for John Deere. People heard of John Deere? Okay, especially if you're from the prairies, okay? So what you need to do, let's go through this. For 2015, all I want you to do is get comfortable with reading financial statements. I want you to pick out the total sales, net income, earnings per share. When it comes to the percentage decrease and increase, all you have to do is divide one number by the other. It's basic math to get the percentage. Okay? If you don't know how to do that, Google it on how to just do that. It's a very quick calculation. But you want to understand percentage increases or decreases to do your analysis. Then for question number 2, you're looking at the balance sheet. Okay, and I'm asking you for different numbers. Question number 3. The stock price for John Deere at the end of 2014, we're on page 74, was $90.70. Calculate the price earnings ratio. Okay, this is what the stock price was at the end of 2015. Was it a better deal to buy John Deere in 2014 or 2015? And why? Okay, look at the last word. It says why. So we don't want to just see the calculation. We want to understand why you made that decision. Using the same stock price, calculate the price per sales ratio. Was it a better investment to buy John Deere in 2014 or 15, and why? Then I'd like you to go to the selected data page. So if you look at page 72, remember I was telling you that if you go to an annual report, it gives you 10 years of information. So from that page, I want you to tell me they've experienced a decrease in most of those indicators. Why did that occur? And what's the cause for the concern? If there is a concern, and explain your answer. Then I want you to go to the consolidated income statement page, look at their research and development costs, and tell me if that's good or bad. And then you're going to have to do a little bit more research. I'd like you to go into the annual report for John Deere for 2015. You're going to have to fire up your computer and actually go into John Deere's website and get the annual report for 2015. And you're going to have to read it. You're going to have to read the management report, which is a couple of pages, and it tells you what the CEO is thinking about their strategy. And I want you to tell me whether you think the company is going into the right direction or not. And then the last question is, after you've done all that analysis, is based on your analysis and what you've learned over the last couple of weeks, would you invest in John Deere? And then you need to tell me why or why not. Okay? So it really puts together all the things that we've been learning around net worth statements, how to read financial statements, how to look at quantitative and qualitative analysis. Okay? If you need help, you can call me, or you can. Are you going to send Oleg's number? Okay. Yeah, don't wait till next Tuesday to do the assignment and then try to call somebody for help. This will take a little bit of work, but if you want to understand how to pick stocks, this is what you have to do. Okay? Good. We'll see you next week. And next week's going to be an exciting class because we're going to learn about private deals. Good. Have a good night and a good week.
Oh, yeah. I'm not.
I sent your sent it out.
We'll set up a meeting with you to go into talk about it.
Yeah, that's all you can do.
I know.